Recording in progress.
So shall we move to the disclaimer, ma'am? Yeah. So this is a disclaimer from company's point of view. You may take a print screen of the same and you can go through it in detail. Yeah, this is today's agenda. First, I will give brief introduction about the company. Later on, Shreya ma'am will give the investor presentation for Q4 of the financial year 2024-25. And later on, Reddy sir will take all the questions of the participants. So these are the guidelines of the call. All the participants are kept on listen only mode by the host. All the participants are requested not to record the call. Questions from the participant will be addressed in a Q&A session at the end of the investor presentation by the management. During the Q&A, when called out by the moderator, we request you to introduce yourself with your name, organization, and the question. Participants having multiple questions can email us on email ID mentioned in the chat box, and management will make best possible efforts to respond within 7 days. Thank you for your cooperation. So dear participants, welcome to the Q4 earnings call of the financial year 2024-25 and investor presentation of Synergy Green Industries. Synergy Green Industries Limited is one of the India's leading state-of-the-art foundries producing SGIL, grey iron and steel casting for wind turbines, wind gearbox and general engineering industries in the weight range of 3 metric ton to 30 metric tons. Synergy Green Industries has an installed capacity of 30,000 metric ton per annum and is in the process of upgrading up to 45,000 metric ton. The company houses best-in-class equipment, IT infrastructure and quality testing facilities and is a top supplier to major wind OEMs as well as leading gearbox players in the world. SGIL is a part of the Shirgaonkar Group, which has diversified business interests over its 80+ year history spanning across sugar manufacturing, foundries, hospitality, and market research, among others. So these are the panelists for today's meeting. First, Mr. V.S. Reddy, Executive Director. He is a BTech in Mechanical Engineering, MTech in Manufacturing, and Executive MBA from IIM Bangalore. He has over 30 years of experience in manufacturing of large castings. Over his career, he has worked for corporate like L&T, ISGEC, and Simplex in establishing plants and managing businesses before joining Synergy Green from inception. Secondly, we are having with us Shreya Shirgaonkar, Management Executive. She has completed her MBA in Finance and has worked with Deloitte as part of their Energy and Industrials Research team for over 4.5 years before joining Synergy in 2020. And myself, Nilesh Mankar, I have done MBA from Indira Gandhi National Open University and I have completed my company secretary and working with Synergy Green Industries for more than 13 years in secretarial department. So now I would request Shreya ma'am to start the Q4 presentation for the financial year 2024-20.
Sure. Thank you, Nilesh, and good afternoon, everyone. And thank you for taking the time to join us today. I'll be walking you through the performance for the last quarter and the full year, along with a quick snapshot of the industry landscape, and then finally talk about what we see ahead in the business. It's been a year of steady progress for us, with strong momentum on our strategic investments and encouraging signs from the broader industry. So I'll start with a quick look at the industry trends. We'll move into the highlights of our performance, and then finally touch upon the outlook for FY25-26. So as we know, climate urgency, geopolitical disruptions, and fragile supply chains are all around us, and the global economy as we know it is being redefined. and it's being redefined around resilience, renewables, and sustainable manufacturing. Renewables and therefore the wind industry are not just clean, they are critical at the moment. Simultaneously, India is also rising as a global manufacturing hub. As we know, the global economy is expected to grow to $112 trillion by 2025, and renewables are expected to form about 70% by 2050. And the world is also betting on renewables. We see that there are at a global level net zero targets, Paris Agreement, climate financing, and also at country levels, such as India's Panchamrit goals at COP26. Coming to the wind installations, at an India and global level, so India has had 4.10 gigawatts of onshore new capacity additions in FY24-25. This is a 20% growth over the previous year. There are some key growth drivers that are supporting this kind of growth. One is the minimum renewable mandate to DISCOMs. There is the 10 gigawatt of annual wind bids and wind RPOs, which are expected up to 2030. And this is all in line with the targets that are set by the government for a carbon neutrality by 2070. Looking at a global level, global wind installations have they've achieved 117 gigawatt of capacity additions in 2024. This is nearly equal to previous year's highs, but still falls short of the 320 gigawatts annual installations which are required as per the COP28 target, which is to triple global renewable energy capacity by 2030. What the GWEC, or the Global Wind Energy Council, is projecting is a compounded annual growth rate of 8.8% through 2030 for additional wind capacity, and adding nearly 1 terawatt of capacity during this period. Just to put this into perspective, there is a magnanimous growth runway for the industry, which has taken the last 40 years, or historically, it has reached its first terawatt mark in 2024, and it's set to achieve the same feat within an accelerated timeline of just 7 years by 2030. Looking at the market that we operate in, that is the large castings market. As we know, at a global level, the total demand for all castings is 110 million metric tons. We are mainly focused towards wind, and wind demand for castings is 1.5 million metric tons, which is estimated to cross 2.3 million metric tons in the next 5 years. Additionally, large castings market is estimated to be over 8 million metric tons for us. I'll quickly go through the company profile. As Nilesh mentioned, SGIL is one of India's leading manufacturers of large-size critical castings for wind and general engineering products. Our weight range is between 3 to 30 metric ton single-piece castings, and we're in the process of upgrading to 45,000 tons per annum capacity. We have state-of-the-art facilities, and to draw your attention to the quality certifications that we have, in addition to the ISO 9001, 14001, and 18001, we've also added a TPG certification, as well as ISO 27001 and 50001, which stand for Information Technology Management, as well as the Energy Management Systems, respectively. Our products are mainly catering towards wind castings, which account for about 70% of our overall product portfolio. Besides these, we also cater about 15% of our portfolio to gearbox castings, and the balance goes towards non-wind castings, such as to applications in mining, plastic injection parts, as well as pumps. Coming to our customers, which are one of our key strengths for Synergy, looking on the left-hand side, we have a chart showcasing the leading wind OEMs in 2024 globally. Out of these, Synergy is a trusted partner to 50% of these top 10 wind OEMs globally. Vestas, Siemens Gamesa, GE Vernova are already clients that are onboarded for us, and Envision and Nordex are in the process of getting onboarded. Besides these, we're also partnering with Adani, Senvion, as well as Flender and ZF in the gearbox space. And at the bottom, we have some of our key non-wind customers. Finally, looking quickly at some of our strengths, opportunities, as well as weaknesses and threats and how we plan on overcoming them. Our strength is the ability to produce large-size castings up to 30 metric tons and to build large capacities with highest capital efficiency. We're also, as I mentioned, we also have established products with top global OEMs. We see excellent growth opportunities in renewables with high entry barriers in terms of both knowledge as well as technology. India is also being converted as a manufacturing hub, and that is offering excellent potential for growing casting demand. Trade wars and global sentiments are also favoring India's demand. Some of the weaknesses that we see are the limited capacity that we have compared to some of our peers. This we're kind of mitigating by scaling up in the current year to 45,000 tons per annum. Secondly, we're also outsourcing 100% of our machining, of which in the current CAPEX cycle, we'll be taking some of this capacity in-house. Some of the threats that we foresee are a concentration to the wind industry. However, our facilities can produce large-size castings to any other industry with some lag. We also see that there are volatile commodity prices could impact profitability. However, our key commodities are hedged with customers on quarterly basis. Coming to the business performance, looking at our annual capacity utilization, over the years, we've increased our capacity utilization with sustainable growth in production. FY24-25 marked a milestone year with our foundry operating at near peak utilization of 88%. This reflects our strong execution and a robust demand environment. It's also reflecting a strong alignment between our production capacity and customer demand, and it validates the need for our expansion projects, which are already under. Moving to the income statement, our total income for the quarter ended 31st March 2025 stood at 97.91 crores. This is an 18% growth from the same quarter in the previous year. For the year ended March 2025, our total income stands at 363.68 crores, an 11% increase over the previous year. PBDIT for the quarter stood at 15.31 crores, a 45% increase over the same period in the previous year. And for the entire year of FY25, PBDIT stood at 53.70%. This is a 31% increase over the previous year, where PBDIT was 41.10 crores. Looking at the PBDIT margins for the quarter stood at 15.64%, a 294 basis points increase over the same quarter in the previous year. For the entire year FY25, PBDIT margins stood at 14.77%. This is a 224 basis points increase over the 12.53% PBDIT margin in FY24. The profit before tax increased by 90% in the fourth quarter of FY25 and stands at 7.67 crore. For the entire year, PBT stands at 24.99 crores, a 60% increase over the previous year. Finally, profit after tax clocked in an 18% increase in the latest quarter and stands at 3.84 crore. Similarly, profit after tax for the entire year stands at 16.89 crore, a 46% increase over the previous year, which stood at 11.56 crore. Looking at some of the key highlights of the balance sheet, which remains healthy and positioned to support our growth plans, our net worth has strengthened by nearly 2.5 times, which is supported by solid internal accruals and the successful rights issue, which we completed in October 2024. This capital raise has improved our leverage profile, and it also reflects the confidence of our shareholders in our long-term growth strategy. Coming to the borrowings, we've undertaken to increase the long-term borrowings to support our CAPEX program and remain comfortably within reasonable debt levels. Our trade payables have remained stable and within our working capital norms, and our vendor relationships remain strong. Our payables position reflects our healthy procurement cycles, which are aligned with our expanded operations. Coming to the assets, Non-current assets have increased in line with the execution of our CAPEX rollout and includes investments already underway towards equipments, civil, etc. Trade receivables saw a slight increase during the year. This is primarily due to last-minute receipt of certain letters of credit near the year-end, as well as growing business from MNC clients. Many of these MNC clients operate on open credit terms, but these are high-quality receivables with very low risk, and that's why they are also aligned with our strong customer profile. Our inventory levels are within the controlled expected levels. A brief overview of our revenue streams and PBDIT. Our revenue streams are split into 5 areas: wind domestic, OEM exports, direct exports, gearbox, and non-wind. During the year, FY25, we recorded a revenue growth of 11% over the corresponding period of the previous year. This was largely driven by direct exports as well as gearbox segments. Based on the executable order book projections for the coming year, we expect a 20% growth for FY25-26 in terms of revenues. Looking at the PBDIT margins expanded by 224 basis points from 12.53% to 14.77%, as I mentioned earlier. In absolute terms, we've had a 31% increase in PBDIT and stand at 53.7 crores for the year. Additionally, the board has also recommended a 10% dividend on equity for the year. Coming to our overall cost structure and CAPEX plans and the status of our CAPEX, the CAPEX plan for about 187 crores has been split into 3 areas: foundry, captive renewables, and in-house machining. The foundry capacity expansion is well underway, and we're expecting to receive the operational capacity in Q2 of FY26. The renewable project to increase from 2 megawatts to 10 megawatts is already underway, and we're expecting it to be operational this month in the first quarter of FY26. In-house machining was split across 2 phases. The first phase, we expect it to be operational by the 3rd quarter of FY26, and the second phase to be operational by the 4th quarter of FY26. At SGIL, we also believe that environment goes hand in hand with economics, and we've taken various initiatives to triple the bottom line. These include technology leadership such as process automation and digitization, energy optimization, reducing our carbon footprint through renewables and achieving 50% green production by 2030, and also waste management. In terms of waste management, we've also enhanced our sand recycling from 92% to 98% with the help of thermal reclamation. Finally, we come to the performance outlook and some medium-term outlook. For FY25-26, we're expecting a 20% revenue growth supported by robust order book projections from major OEMs, as well as some benefits of capacity expansion. We're expecting export revenues to remain stable, close to the previous year, and PBDIT margins are expected to expand by another 100 basis points from the previous year, supported by partial contributions from some of the strategic ongoing investments. That said, many of you know that as a part of our expansion, including capacity additions and new infrastructure, these will be actively underway during the first half of the year. So we do expect some operational disruption in Q1 and slightly more in Q2, because construction activities as well as commissioning activities will be picking up pace. This may have a marginal impact on our output, but it's something we've already factored into our planning and customer schedules. And most importantly, these are temporary and well-managed adjustments, and they tie into the long-term capacity and capability building. And we're confident that we'll begin to see some partial benefits of these investments in the second half of the year. Finally, in terms of medium-term capabilities and the path ahead, we do see an opportunity for one more greenfield expansion in the next 3 to 4 years. But at the moment, we'd like to concentrate on seeing through the current round of CAPEX over the next year, and then give another couple of quarters before we begin planning for the next leg of growth based on a very strong balance sheet. With this, I would like to end the investor presentation and hand it back to Nilesh to open the Q&A. Thank you.
Thank you, Shreyama. So I can see 4 5 hands has already been raised. So without wasting much time, I will start with the Q&A session. First, I would request Aditya Mutha sir. You can unmute yourself and ask your question.
Hi, ma'am. Congratulations on getting back on the growth path. One question, ma'am, you are constantly missing your guidance. So what gives you confidence to give a 20% growth guidance for FY26?
Myself ready here. See, if you look at the last year guidance, what we gave, around a 200 basis point or 150 to 200 basis point growth in the EBITDA margins. And also we given a guidance of 370 crores top line. If you look at the actual outcome, EBITDA remains same, more or less within just a 0.5% deviation. And the top line as against 370, we did about 364, maybe around 2% short of the guidance what we gave. But there is a increase in our EBITDA margins as we are almost reaching closer to 15%. So I don't see there is a big gap between what we have guided and what is really happening. As far as growth is concerned, we don't see any challenge actually, So we have already backing with a good order book. One of the constraint what we have last year is the capacity constraint, because we are working with almost 88-90% kind of the capacity utilization. Once the new capacity comes in place, I don't see any reason there should be any challenge. In fact, if you look at the current year, the order book is much higher than what we are given a growth guidance. But we're constrained by the capacity constraint, so we need to push back some of the schedules to this third and fourth quarter, because once the capacity comes in hand, we'll be able to take the more and more orders.
Sir, so I was reading a note from Novama, September 23. They visited your plant, and you were about to expand your capacity at that time also. So still the capacity is not expanded. So that is also a pushback.
Can you please quote the period when you are talking about?
September 23, Novama came to visit your plant, and there was a note from Novama. They clearly mentioned you were talking about you were talking to take a capacity from 30,000 ton per annum to 45,000 tons per annum. But
see, yeah, I understand you. So there are two minutes. One is we were expecting this fund to be capital to be raised in the May 2024. But actually, by the time we complete the approvals with the stock exchanges and the investors and all, we ended up in raising these funds in the month of October. Once we have a funds, then only we'll be in a position to commit these orders. So accordingly, it is aligned. So again, at the end of the day, capacity expansion is not an overnight issue. It's going to take at least 6 to 9 months to do that. We are well aligned to complete that expansion.
Okay. And one question on bookkeeping side. What is this 3 crore of deferred tax which came up in this quarter?
See, since we are in an expansion mode, there are certain assets where, as per the income tax, we are entitled to get the income tax benefit, actually. This is a notional entry into the balance sheet. This will be the future obligation. Once the corresponding depreciation comes, that will be getting knocked off. But as per the physical cash flow is concerned, actual tax paid is only 5.1 crore, actually. It is mainly because of the expansion activity. For example, there are electrical equipments or certain asset class. We are allowed to take 100% depreciation in the day one. It's an income tax calculation related thing.
Okay. I'll get back in the queue, sir.
Yeah. Nitin Dharma, sir. Yeah.
Yeah, thank you for the opportunity. Am I audible, sir?
Yeah, please go ahead.
Yeah, okay. So towards the end of the presentation, Shreya mentioned about the impact of disruptions in, there are some likely disruptions in Q1 and Q2 results. So I would like to understand the impact of that disruption, and if that is there, what is the overall impact on the financial year 26?
See, whatever the growth is going to come, predominantly it is going to happen in the second half of the year once the full capacity is in place. As far as the first quarter and second quarter is concerned, it will be at par or it will be better than the previous the quarters. But if you look at the growth, because somebody may be counting every quarter uniformly getting 20% and all, because majority of the growth is coming in the second half of the year. And we have also aligned our order book accordingly. See, we have taken a lot of new orders like Envision or Nordex, even Adani and all. Right now, development activity is going on. So it is also getting aligned with our capacity addition and completion of the product development activity.
So will there be any impact on the EBITDA in Q1, Q2 because of that, or it will not?
I don't see any impact under the margins, actually. It should be more or less in line. Only growth may be coming in the second half of the year. That's all
I got it. My next question is, what is the total debt that we have on a consolidated basis now?
Total debt, just 1 second. As of March closing, we have about 121 crores. But we are not utilizing the complete sanctioned lines from the bank, because still cash out payments have to be done during the first quarter and second quarter of this project execution, actually. So finally, we are looking at it may be around 100. There are two parts. One is the long-term borrowing. The second is the working capital. Working capital may slightly go up because of the increase in the business. As far as long-term is concerned, we are expecting somewhere around 160, 170 crores is the in total, actually.
Okay. So we announced dividend. That's a good thing to do. However, my concern was that since we are having some debt and long-term debt as well as working capital requirement, and we are going through a capex mode, so would it not be a prudent idea to defer this? As a shareholder, I welcome this, but on the other side, I have to look at from that perspective as well.
See, dividend cash outflow is a very small amount, actually, because this company is into operation for almost 15 years now. So since continuously last 3-4 years we're making good profit, so we also need to take care of the shareholders as well, actually, because total dividend outflow is just 1.55 crores. So it is a small portion of the whole earnings.
I got it. My next question is, what is the additional tariff that we may have from the USA? What will the impact on our profitability because of that, if any?
See, as of now, there is not much clarity on the tariff, because the proposed tariff of 26% is put under pause. As on date, just 10% is there. We believe the government of India will be negotiating further without anything. At max, there may be a 10%. I don't think a 5% or 10% is going to have any impact on our business relationship with the US clients. But we need to closely see how the tariffs are going to be on the China, actually, relatively. So that's how we look at. But at the end of the day, I don't see much impact because of the tariff, either on the demand or on the profitability. In fact, if you look at previously, the way US and China were continuously increasing the tariff, I was getting a lot of calls from US clients. Can you increase your schedule, dispatches, actually. But again, since we are already concerned with capacity, we are not in a position to take additional schedules, actually. So as on date, I don't see any negative. In fact, whatever is there, it seems to be a little positive only from the tariff point of view.
Yeah, I missed to introduce myself. My name is Nitin Dharmaut from Aurum Capital. One final question is, I just wanted to check why the depreciation was lower. We had, done expansion, and some of that must have been, on a stream now. So expectation was of a higher depreciation. So that's the reason for asking this question.
Yeah, as far as the last Q4 depreciation is concerned, there is a marginal reduction over the previous quarter. One of the reason is when we did a Q3 reporting, we were calculating solar project as also with the WDV method. That's the written down value method, actually. This is methodology used for all the asset class. But during final audit, auditors have got clarification that this solar asset class need to be follow the straight line method. That is the reason why there is around 65 lakhs worth depreciation has to be reversed. So that's the reason why you see in the Q4 there is a minor reduction in the depreciation, actually.
I got it. Wishing you best, sir.
Thank you. May I request Mr. Darshil Pandey from Pinterest Capital?
Yes, sir. Hi. Thank you. Good evening.
Good evening.
So just to understand from the previous participant's question, what would be the depreciation for this financial year?
This again depends upon the how timing of the capitalization of the assets and all those kind of things. But how we look at it is what is more important is the next year, actually. So at peak level, it may go up to as around 24-25 crores. This year, it may be closer to 18 to 20 crores is what we are estimating, actually. We need to detail calculate based upon the asset capitalization.
Okay. And sir, just to understand, from your understanding, I saw one of the presentation slide where where we have discussed about the wind installation, where it grew by 20% this year, and last year it was 71%. So is the capacity only the issue that that we are not able to grow with the industry or something? What is it?
Yes, because we are already utilizing 88% kind of 88 is not this thing, it's a big number as far the utilization is concerned, actually.
Correct.
So one of the reason is yes, you are right. It's majorly is the capacity constraint, actually, today.
And what capacity today we are adding around 15,000 tons. What kind of revenues can this give us?
See, as we quoted earlier, we are expecting somewhere above 550 to some or up to 600 crores is what we're expecting from the existing new capacity addition. But actually, if you look at the order book, what we are taking and the new customer we are adding, it's already appearing that it's exceeding, overshooting the 600 crores kind of the order book actually, no?
600 crore is the order book is what you're saying?
No, not like that. The products which we are developing, the visibility for exceeding the 600 crores kind of the order book.
By when? By what time?
See, the next year we should be able to do another 30% plus growth what we are expecting actually, no? So next year, majorly around closer to 530, 550 crores we should be able to reach.
Absolutely. Absolutely. And one last question is on the cash flow statement side, sir. So what is this other current financial assets of 48 crores in the cash flow?
See, this is mainly because of the GST amount. When we do the capital expenditure, we get a GST credit that goes under other financial assets, but it will get diluted during the course of business. When we do the invoicing, some of the portion of the GST will get reversed into our books.
I'll get back into some few more questions.
Thank you.